This is the current federal tax developments for the week of January 20th, 2025. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. This week, we're going to look at a few things. First, we're going to talk about an IRS update to its residential energy credit fact sheet. And probably the biggest change that came from the prior version, though pretty much every question was edited in some form, is requirements for the PIN, the manufacturer PIN requirements that will begin to take effect as clients acquire property they want to qualify for the credit in 2025. We'll discuss how that's been laid out in the FAQ, the first year relief we're going to have of sorts, and then what will be required in 26 and later years. Also, coming up, we're going to be looking at proposed regulations on the catch-up contributions that were added by the Secure 2.0 Act. You may remember that we have various rules impacting that, primarily the special additional contribution for those who have attained age 60 to 63 as of the end of the year for the plan, as well as the special rule requiring Roth IRA deferrals for those whose income is above $145,000. We'll discuss how those played out in the regulations and what we have. We also have another Secure Act change, Secure 2.0 Act change, and this is the automatic enrollment provisions of Section 414A that is required for most new 401k, 403b plans put in place after the enactment date of the Secure 2.0 Act. So we'll talk a bit about those, some of the exceptions, and then how that all ends up working. So that's another neat little thing we have coming. The U.S. Supreme Court did agree to review a Third Circuit ruling on whether the tax court has jurisdiction in a collection due process case. The IRS pointed out that we now have a split in the circuits. We have two circuits that have said that if you have a collection due process case that is being filed and then due to the taxpayer overpaying in later years while we're in litigation, the tax ends up going away, being fully paid off, and therefore we're no longer worried about the collection action. Does that moot the point if, as part of that collection action, the taxpayer was taking advantage of the option to dispute the underlying liability? The Third Circuit says, hey, nope, doesn't moot it. The other two circuits have said it does. We'll see what the Supreme Court wants to say about that as we move forward. And we also have the IRS issuing final regulations on the resolution of tax controversies by the Office of Appeals. And we'll talk about one of the more important things involved there, which is the discussion of things that appeals will not basically take into consideration. And one of the key ones is going to be challenges to the validity of regulations. And where that is, it becomes important simply because of the Loper-Bright case. And we'll talk about what that does and the practical implications that has for you if you think you've got a Loper-Bright challenge available to a reg that may not be valid. This creates a practical problem for you. We'll talk a little bit about there. It's not they won't ever consider the argument, but as we'll quickly discover, you need somebody else who have taken it to court, succeeded in getting the regulation ruled to be, invalid, and then either the IRS loses every appeal, or they simply failed to file an appeal by the time the deadline hit for them to appeal that decision. So we'll talk a little bit about that. So let's start with the energy efficient home improvement credit and the residential clean energy property credit frequently asked questions. This is an IRS announcement that's in a fact sheet, which says updates to frequently asked questions about the energy efficient home improvement credit under 25C and the residential clean energy property credit under 25D. Fact sheet 2025-01. This one came out on the 17th of January. Now, what's happened here is the IRS has issued a newly revised fact sheet for the credits under 25C and 25D, right? And this contains updated details on the standards that each qualifying item must meet in order to qualify for the credit. We've all been used to this credit. We know there was some major changes made to it in the Inflation Reduction Act, and this is just continuing out what we've got there, right? We have that background. One of the bigger things, though, this goes into, because now it's going to start to become relevant, is we are starting to hit the qualified manufacturer requirements. And so we want to talk about what those are, how that's going to work, both from the manufacturer side and from the side of the, probably what's more important to most of us, the homeowner side. That's how we're going to handle that. So we'll talk a bit about how that one's going to go. Right. Now, to be eligible for the credit, for any item of specified property, and it's not all property, things like insulation are not covered by this rule, but other things are. Any property placed in service after December 31st of 2024, that means placed in service today or later, or placed in service the last couple of weeks or later, the specified property must be produced by a qualified manufacturer. And as we'll discuss, that party has to register with the IRS. And the taxpayer must include a qualified product identification number, a PIN, on the tax return. That's technically required for 25 returns, but we'll discover that actually we're going to get a little bit of a break for the 25 returns, but in 26, both of those, we will need to have a qualified manufacturer, and we'll need to have the full-blown qualified product PIN to place on the tax return. This is going to complicate working with clients, because we all know clients will just swear to us that their contractor told them they don't need this, that their buddies have had no problem with filing with this, they were told, etc. Yeah, we know how that's going to go. And then when their return rejects due to e-filing, or even worse, the IRS accepts the return and then bills them back, now suddenly we're in trouble. That's kind of how this thing goes. Okay, so specified property, the stuff that you need to have the ID number for. That includes anything under 25D, the Residential Clean Energy Property Credit, as well as any property described in 25C, 3B, which is basically includes skylights, exterior windows, or C, exterior doors. They must have these pins to go with them. Qualified energy property would include things like heat pumps, and that kind of stuff is under that static category as well. And a manufacturer must register with the IRS to be considered a QM. So that's the first step. A manufacturer that fails to register with the IRS, I don't care how great the product is, you can't claim the credit on it. And that's going to be true in 25. The manufacturer, being a qualified manufacturer, is going to be required in 25. So that's a key for starting. Right. Once the manufacturer's application, not the taxpayers, to be a qualified manufacturer is accepted, there will be a unique 4-character QM code, qualified manufacturer code, given to the manufacturer. Now, as we'll discuss, for 2025, as long as you have that code from the manufacturer, even if they don't have the PIN, that's going to be fine to put on the return. So, we're going to talk about how that all works. The IRS apparently believes needs some time to fix this up. So we are going to be getting that code, but it's going to be important that taxpayers understand for 25, they have to make sure they're getting their stuff from a qualified manufacturer who has gone through the registration process with the IRS. Now, the IRS is providing the manufacturers with a bit of time into 24, or 25, I should say, to, get registered. So if somebody doesn't have it today, that's not necessarily fatal, but they need to get the process completed, right? Get it going. And there's only, I think it is the end of April, where we have the date that they can register through and still be qualified for the entire year. After that, they would apparently only be qualified after the date that they had registered with the IRS. Okay. Now, after they have their QM, they will then assign a unique 17-character PIN to each item of property they produce. So basically, you will have a QM code. So the QM code will start that PIN, and there are other parts of it that are assigned, and one of which is just assigned by the manufacturer, which they'll probably just do it in order. So we're going to have this 17-digit code. Again, as I said, we'll talk about the relief here shortly, but that code will be needed for 26 returns, and probably not a bad idea for your client to get it for 25 returns, because obviously everything a qualified manufacturer makes isn't necessarily going to qualify for the credit. So it gives you a little more safety if you figure that they've assigned the 17-character PIN. That tells you that, yeah, this qualifies. So might not be a bad thing to get this year either, assuming they're available. We'll get that. Now, the PIN requirements, right, must include the PIN for any item of specified property they place in service on or after January 1st, 2025 on the return. But there's a caveat here. Yes, the PIN is there, and that's what the law says, right? But the special relief we have, if you're placing it in service in 25 by December 31st of this year, you can use the QM code alone in place of the full PIN. That will allow you to, in essence, claim it without having the full PIN. The full PIN, though, will be required in 26. So January 1st, 26 or later, if that's when this thing gets installed and placed in service, you got to have the full 17-digit PIN. That's required by statute in the law. So it's not one of those things that the IRS technically can just say we're going to ignore it, right? They have to start enforcing that. That was part of the IRA requirements. That this is what is going to be done. Okay, next up, let's talk about the IRS's proposed regulations on catch-up contributions due to the Secure 2.0 Act changes. This is REG 101268-24. That's the proposed reg. It was issued on January the 10th. Now, there were some key changes on catch-up contributions that were introduced as part of the Secure 2.0 Act. First, we have the increased catch-up limits for those who are age 60 to 63. This was Section 109 of Secure 2.0 Act. Now, for those who are not aware, this means for taxable years after 24, that means this year, the applicable dollar catch-up limit is increased for participants who attained age 60, 61, 62, or 63 during the year. Specifically, the increased limit for the non-simple plans for this year is $11,250, which is 150% of the $7,500. And the increased limits for simple plan, I should say for non-simple plans is $11,250. So that means 401ks, 403bs. The limit for simple plans is $5,250. Now, there's a quirky, odd way that they came up with that based on which year's limit you use. And that was discussed when we set the inflation numbers for that. Just say, for right now, those are this year's. These are subject to inflation adjustment, so they will change in the future. But for right now, that's your limits for 2025 in these plans. Now, right, so there's also Section 117. That added increased catch-up limits for certain simple plans. Okay, this is an addition. Now, for taxable years after 23, certain simple plans sponsored by employers with 25 or fewer employees can automatically apply a higher catch-up limit, while other eligible employers can make an election. They have to put money in essence, to make the limit. So we got 25 or fewer employees. So obviously, one of the key things going to be with this provision is figuring out how to count employees, because that 25 is important. If you use this limit, that increased catch-up limit will be $3,850 or 110% of $3,500. And yes, this does work. In essence, you have this limit, but if you're in 60 to 63, you will have the secure increased limit and not this one. So you don't get this one and that one. So don't get confused. It's one or the other. Finally, Section 603, and what should have been in place last year, but it's been delayed till 26 by the IRS administratively, but this is the Roth catch-up requirements, right? This will say that once this comes into effect, which right now is scheduled for 26, it should have been in effect last year, but the IRS delayed it because the regs weren't ready, and there was a lot of other things to deal with, so they essentially kicked it back 2 years. But this will be a participant whose prior year FICA wages from the plan sponsor exceed $145,000. The catch-up contributions they make must be designated Roth contributions. Now remember, if we're talking about a calendar year plan, the prior year for the 26 plan year is going to be this year. That does suggest from a planning standpoint, you understand that anybody goes over $145,000 worth of FICA/Medicare wages during the year is going to be limited next year or have to do the Roth catch-up instead of the traditional, deductible 401k catch-up. They'll have it. Now, this requirement does not apply to SEPs or simple IRAs. So neither one of those have to require this. Now, SEPs really don't have catch-up contributions unless they're a SAR SEP. So that's going to be a very, very limited category. But there are simple IRA plans out there. They are not subjected to the Roth requirement for the catch-up. So that will be part of it. Now, the proposed regulatory implementation. Let's talk about this. Let's start with the deemed Roth election. You're over the limit. What are we going to do about this, right? Proposed regulations permit plan. Let's say the participant had made a pre-tax election, coming up to the end of 25, they make a pre-tax election, to defer to the 401k plan. And they said, nope, they didn't choose the Roth. They choose the regular IRA account. Okay. And they've elected, or not regular IRA, but regular 401k, the one that's excludable from income. And they checked, they said, yeah, that's what I want. I want to do it that way. A plan is allowed to treat that pre-tax election as a deemed Roth election if they're subject to the Roth catch-up requirement. However, if they do that, that's conditioned on the plan allowing for a subsequent election to change this, meaning fundamentally to back out, right? Back out of the catch-up, because the catch-up has to go in there, right? So essentially, right? That would be the background. We've got to do that. Proposed regulation, this will be 1.414 V-2, clarifies participants' prior year FICA wages as defined under Section 3121A, the payroll tax provisions. From the employer sponsoring plan exceeds $145,000, any catch-up contributions must be designated Roth contributions. That'll be part of it. The regulations also clarify the determination is based on the FICA wages of the common law employer. So it's not we're looking at the common law employer, not necessarily worried about that from the standpoint of, the other ones. This involves a lot of leased employee arrangements, professional employee organization arrangements. That sort of background is what that's dealing with, okay? It says a plan does not fail the universal availability requirement under Section 414V4, really because it utilizes increased catch-up limits for those that are aged 60 to 63. This is the 63-year-olds. That could be a problem because obviously that's discriminatory, right? We're offering a different benefit to some employees. So they clarified that, yeah, we understand that, but the law allows for this. So we're going to say that's an exception, because normally you can say, hey, you can catch up, but you can only catch up. You guys can only do this much until you're age 60. And then you could do this, then you could do this much more if you're 61 and above. That's not really normally allowed. But this would do that. There also are correction mechanisms in place that are discussed in here. They established the correction methods for plans that fail to satisfy the Roth catch-up requirement. For pre-tax contributions, including basically correcting Form W-2s and having in-plan Roth rollovers to correct, in essence, take it out of the one that could be deferred pre-tax and move it into the Roth portion of the plan, doing some sort of corrections under that. They have correction mechanisms they're proposing that would allow you to do that, so it could be corrected. So essentially, the plans can correct an error via an in-plan Roth rollover, amount rolled over includable in income in the year of the rollover. So you could find it, that's after plan year found. They also have deadlines, which are generally consistent with the existing deadlines to correct other errors in that background. Okay. So plans must have provisions in place, this continues on this, to ensure compliance with the Roth catch-up rule. That, and to use the new correction methods, including a deemed Roth election feature. The plans have to be updated for that. It's not surprising. We're going to have plan modifications to get these things done. Next up, we have another change from the Secure Act. This is Reg 100-669-24. This is on January the 10th of 2025. And this was Section 101 of Secure 2.0 Act, introduced Section 414 Cap A, the Internal Revenue Code, which mandates automatic enrollment for specific retirement plans. You may remember that the original Secure Act allowed a plan to do this, right? We made it very clear. We opened it up. It encouraged plans to do it. We have now gone from the carrot to the stick. New plans are required to include automatic enrollment provisions, right? That means that cash or deferred arrangements, generally it's going to be 401k, 403b plans, must be structured as what's called an eligible automatic contribution arrangement, EACA, right? Is the acronym the IRS uses for this. That's what we're talking about with that thing. Now, generally, a cash or deferred arrangement will not be considered a qualified one under 401k unless it complies with the automatic enrollment requirements outlined in this provision. So it's a qualification issue for your 401k plan. It will get rid of your deferral options. You'll have a profit sharing plan, guys, if you don't have this, because you won't be able to make the deferrals into the plan. Similarly, for 403b plans, annuity contract purchased under a salary reduction arrangement under a 403b plan will also not be treated as purchased under a 403b plan unless you satisfy 414a. So assuming you're required to have automatic enrollment, this now becomes a mandatory feature. Now, some key provisions here that are in there. First thing is the concept of permissive withdrawals. The plan must permit employees to make permissive withdrawals of default election contributions and the earnings attributable to those in 90 days of the first default contribution. That means effectively, you're going to start taking money from somebody's paycheck. It's automatic. They didn't opt out. What will probably happen with some employees, vast majority will probably never notice it came out, which is somewhat sad if you're an accountant realizing how little attention people pay to such things, but nevertheless, but somebody probably will notice it and say, hey, why are you taking it out there? I didn't say you could take that out. Okay, well, you had to take it out because the law said you did. But they do have 90 days to notice and ask for the funds to be returned. So the plan has to have that. Now, if they ask for it, they get the funds back and they get the earnings on those funds. Right? The earnings will obviously be taxable when it comes out to them. But your plan does have to have that permissive withdrawal provision to allow them, within 90 days of when, the default elective contributions have been taken, they have 90 days to say, hey, I didn't mean for that. Give it back to me. Okay. There are certain minimum default percentages you must use in your plan. This is, again, straight from the law. The initial default contribution must be a uniform percentage between 3 and 10%. So you start with some straight percentage in the plan, and it has to be at least 3% has to be the first year, but you could take it all the way to 10% of their earnings in the first year of the plan. My guess is most employers are going to go for the 3, right? The 3% will be the one used. The default percentage has to increase, though, every year by 1 percentage point after each completed year of participation, up to at least 10%. So we're going to get to 10, right? If they stay around long enough, they're getting to 10 as the default. And no more than 15. You could take it all the way up to a 15% deferral automatically. So your plan will have that. So basically, plans that are covered by this have to start with at least a 3% automatic contribution, automatic withdrawal. Again, and this is an opt-out, meaning if the employee takes no action, which is what Congress knows most employees will do, is do nothing. They'll ignore it. 3% comes out. Every year it goes up by 1 until we get to at least 10%. Now, again, you could have a plan that started at 10 and increased to 15. You'd have a plan that started and ended at 10. You can have all of those options. But we do have this 1 percentage point increase to get to 10%. Obviously, Congress likes 10%. They would like these people to be putting away 10% of their own money for retirement. This is obviously part of the whole goal to try to, save Social Security by having these things be taken care of. Okay. Now, Section 403B plans, we have that issues, right? We talked about these provisions. Whoops. I duplicated the slide. That's not very good. Okay, employee coverage, right? It must cover all employees. So this automatic enrollment must cover all employees eligible to make contributions under the plan. And that does include the long-term part-time employees. Remember that other thing got added? Under Secure Act, you have a long-term part-time employee. We don't need to match, etc. But you do have to start these automatic withdrawals unless they tell you not to. You've got to offer them the option to say not to. Don't do it. But if they just don't respond, the money comes out. Again, that was part of the goal of this, right? The proposed regulations do include an exception on automatic enrollment for certain employees who had an affirmative election in effect, and that remains in effect on the date the plan first became subject to these rules. That means for plans that are coming subject to them because they were established right after Secure Act, and then they're now having to add these when we get to the effective date of this. If an employee already has an election in place, and that election stays in place until the employee changes it, that employee will be able to stay with that election. Right? We're not going to force people who made an affirmative election. Now remember, it's an affirmative election. If your plan only took money out, if the employee said to take it out, if the employee did nothing, took nothing out, that does not appear to be covered under the proposed regs. Right? It looks like in that case, you would have to start taking the 3% out. So, if the employee said take nothing, they sent back an election and checked the box and said take nothing. They made an affirmative election, then that's fine. We don't need to worry about this particular plan and its issue, okay? Some exceptions to these plans. Simple 401k plans, I don't see many of those, but they're out there. They're not subject to this, right? Neither are governmental and church plans. Now, again, remember, simple 401k plans are where you establish your simple plan, but you're not using IRAs, right? Remember, these apply to 401k and 403b plans. So simple IRAs aren't covered by it, but simple 401ks would be, except for this exception. Governmental and church plans are exempted. New businesses are exempted. This is an interesting one. The plan is exempt if the employer and any predecessors have been in existence for less than 3 years. So a business that's less than 3 years old does not have to do that, assuming they have a plan. Remember, they don't have to have a plan, so it's also part. The proposed regulations, the plan won't fail to meet these requirements if they implement this by the first plan year that begins on or after the third anniversary of the employee's existence. So if you started a brand new employer, let's say in May of 25, you're going to not have to actually put employees in until the 2029 plan year, because it'll be the first year begins after the third anniversary. So it's not the third plan year, right? They would have a plan for 25, let's say, 26, basically 20, 25, 26, 27, right? They would have plans for those years. But the 28 plan doesn't need to have this in it yet because, again, the employer has not yet been around for 3 years as of the first date of that plan year. So that does make a difference in there. Also exempt are small businesses. A plan is exempt for the first plan year that begins at least 12 months, right, after the close of the first taxable year in which the employee normally employed more than 10 employees. And that normally employed issue is determined under the rules of Q&A 5 of the, section or regulation 5449-80B-2 from the Affordable Care Act. This is how we determine that, right? You're considered to have normally employed fewer than 20 employees during a particular calendar year if and only if it had fewer than 20 employees on at least 50% of its typical business days for that year. So you have to take a look at, how many employees per day. And normally, you had to have that, right, had fewer than 20 employees on at least 50% of its typical business days for the year. So let's say, you're Monday through Friday, you come up with how many business days you were open. You take half of that, right? You need to have fewer than 20% on at least 50%. So if that's an even number, you get, let's say, an even number of days, 200 days, whatever the number you came up with. You had 100 days, you're fine. If you were below 20 on at least 100 days, right? But 101 days, but let's say you only had a 99, you wouldn't be good enough. It has to be at least 100 that you're up to, okay? The other things we've got here, And we talked about this as well. All full-time and part-time common law employees, employer are taken into account. So if you have part-timers that come in, you don't ignore them. You have to count them. Even though they would not impact you for purposes of, because remember, we're starting to have this crazy, long-term part-time employee theory. So it's saying part-time, and it's also employees, not participants, right? Not even those who are covered by the plan. This is just employees of the business. You have to understand it is an employment structure is what it is. For multiple employer plans, new and small business exception are applied on an employer-by-employer basis. So that's how that one comes in, right? Also exempt are pre-enactment plans. This is probably most of your plans currently. If it was established before December 29, 2022, it's generally exempt. Now, obviously, that raises a question of, do making changes to this plan, what kind of things could suddenly bring this into it? Where we're there. So they did clarify, the rules surrounding a merger are complex and are laid out in detail. Obviously, mergers get messy because you could be merging pre and post plans. There's all kinds of messes there. So the warning, if you're in a merger, you're going to need to go through a lot of the details of how this goes together. This is not a course on this. Actually, not even a course. This is not a program on doing that sort of detail. So we're not going to worry about that. And similar, the rules regarding an employer adopting a multiple employer plan are also messy and complex. So again, if you're doing that after that date, you're not going to include automatic enrollment. You need to consult the details. Or obviously, you always could do so, in which case then we don't worry about these two things. But it's there, and that's how it goes. If you have spinoffs, they do have a pretty clear thing here. If you spin off a portion of your plan, so you divide the plan, that resulting plan is still a pre-enactment plan. So if the plan it was spun out of was pre-enactment, a spun out plan will automatically be a pre-enactment plan and not required to make use of these rules. So that's positive, presumably, we think. Amendments to a plan also, question is, if we amend the plan, does that somehow make it post? And they said amendment to a plan that do not relate to adopting a multiple employer plan or a plan merger will not cause a plan to lose its status. If you are adopting an amendment to adopt a multiple employer plan, or you're going through a plan merger, that's when things get messy. To check the regs in detail for exactly what you're doing. Now, the applicability date. The statute says the automatic enrollment under Section 414 applies to plan years beginning after December 31st, 2024. Hi, we're here, right? That we've known that, right? The proposed regulations will apply to plans begin more than 6 months after the date the final regulations are issued. And because, of course, these didn't come out until after this date, they can't very well say you got to use propose. But what they do tell us is that in the interim, right, but before the applicability date of the final regulations, a plan will be considered compliance if you operate in good faith implementation of these rules. So bottom line, we just got to be, good faith is going to be our driver here. Do we have a good faith interpretation of the rules, which is what we had to set up for this year anyway. So that's where we're at. The IRS asked the Supreme Court to hear a case from the Third Circuit. This is the IRS petition for a writ certiorari from the United States Court of Appeals of the Third Circuit. This was Zuck versus Commissioner, number 2022-2244, that was decided on June the 26th of 2024. I should say, right, cert was granted on January 10th of 2025. Now, the IRS argued, because the IRS filed the request for cert on October 11th, get those dates right, and it was granted here on the 10th. This is involving the right of a taxpayer to go to tax court with a collection due process case, right? In this case, it was a proposed levy, right? Now, the IRS is saying that if you had a pre-levy procedure under Section 6330, that's what's here, right? It becomes moot when there's no longer a live dispute over the levy. The issue is Section 6330 also allows you in that collection due process proceeding before the tax court, assuming you meet certain criteria, to raise questions about whether you were truly liable on the original debt. We're going to look at the underlying justification for the tax liability. It's kind of a second chance routine, or first chance because you screwed up. Well, quasi second chance because you really didn't quite do the first chance thing you should have. So we've got that. So the question is, what if we're disputing underlying liability and suddenly the liability goes away because the IRS has confiscated refunds, which is what's happened in this case? We went a number of years. Over those years, the taxpayer continued to have, had refunds every year. The IRS took those refunds, applied them to the amount in dispute. And because of that, eventually they took enough to wipe the balance out. They said, we're not trying to levy anything anymore. Therefore, this is a moot case. And tax court dismissed the case, and tax court did, not making any decision on whether the underlying tax liability was correct to begin with. Right? So the IRS had initially intended to levy, get that right, her property to collect a 2010 tax liability, right? However, her overpayments in subsequent year finally got that 2010 tax liability to zero. At which point then the IRS isn't going to levy anything because they really have no right to levy. There's nothing remaining due. So they abandoned their attempt to levy, and of course they moved to kick it out of court, right? So the IRS argues it's moot. In fact, and the tax court agreed, saying, yeah, it's moot. We're not going to, basically, there is no longer a levy issue here. So we're hearing, and tough luck, Ms. Zuck. I know you're arguing about whether you actually owed any of that tax at all, but that doesn't matter anymore because, this was a dispute over a levy in a collection due process proceeding. So as such, tough luck, but there. Now, the Third Circuit Court of Appeals said, nope, IRS cannot get out of this thing. That dispute was in play. And the mere fact that the levy went away doesn't mean, because there's still the question, if that wasn't the proper amount, that's not the amount, the actual amount was in error, then, she should be able to continue that dispute. And in theory, at the end of the day, recover that difference. Did the mere fact that the IRS finally got the last dollar, does that moot the whole thing, right? Now, the IRS contends the Third Circuit erred by concluding the Section 3330 proceeding was not moot, even after the IRS withdrew its levy. It said, sorry, IRS, you can't pull out that way. That's not how you get out of this, right? It held the tax court still had jurisdiction to review her challenge to the tax liability, even without a live levy dispute being in play any longer, saying that was how we got in, but once we're in, that dispute has to be decided. The court has to go through that or decide that decision. The IRS points out that this has already been decided in other circuits, and in both prior cases, the courts had decided that once the levy issue was gone, there was no longer a dispute under 6330 because it's collection due process related to levies. And there is no levy, so they dismissed. They cited the case of Wilson versus Commissioner from the D.C. Circuit in 2015. There, the circuit held a 6330 proceeding is moot when the IRS no longer seeks to levy the taxpayer's property. And the IRS also had a case of McLean versus Commissioner in the Fourth Circuit in 2022. There, they held the taxpayer could challenge the amount of the underlying tax liability in a hearing only in the context of determining whether the collection action could proceed. So if we're no longer worried about whether collection access can go forward, because there is no collection action any longer, it's a moot point. The case goes out. So now we have two circuits, the D.C. Circuit and the Fourth Circuit, saying, hey, once the IRS is no longer pursuing collection issues, sorry, you can't dispute the underlying liability any longer. And the Third Circuit saying, nope, once that came in, you got to go. Right? The IRS note, the Third Circuit itself acknowledged that its decision parts ways. So the Third Circuit acknowledged that this was not in line with what other circuits had ruled. Okay? So what's happened now is the Supreme Court has agreed to hear this case. And the reason, obviously, is resolve this dispute. There have been a lot of cases now talking about when, tax court's jurisdiction has become kind of an interesting back and forth. And Third Circuit's been in the middle of this a few times now that we have. You may remember earlier last year, the Supreme Court decided not to hear the IRS's request for them to review the Third Circuit's decision in the Culp case. So this time they are doing it, but Culp, Third Circuit's the only one that has yet made that ruling post an earlier Supreme Court ruling in a collections case of whether the general deficiency proceedings are allowed to have, basically have equitable tolling of the statute if there's a good enough reason. So it's been kind of interesting. They're saying, well, there's no other circuit decided this yet. So even though the tax court's saying outside the Third Circuit, they won't accept that there's equitable tolling. The Supreme Court decided it's not ripe to bring it before them yet. They're going to wait and see if, let's say, the Ninth Circuit, the Fourth Circuit, the 11th Circuit, if they all agree that, we should have equitable tolling, or does one of them say, nope, we agree with the tax court, there is none, then that point, probably the Supreme Court would pick up the case like that, but not when there's just one circuit, because only one circuit, there's always a chance the others agree with that one. Supreme Court can dodge it. Supreme Court has never been really thrilled about doing tax cases anyway, so obviously this is one of those things they hope settles itself. This case, obviously it's not. We now have a split. Finally, we have the IRS issuing final regulations, Treasury decision 10030 on January 15th, on the resolution of tax controversies by the IRS Independent Office of Appeals under the Taxpayer First Act of 2019. Remember that bill, which it's been a few years, right? 6 years ago. It was signed into law, and it regarded some reorganization and changes made to the Taxpayer First Act, or should say the Office of Appeals. Basically, it provided that in general, although it still gives the IRS still has the ability to change this or do this. But generally, that appeals resolution process is generally available to taxpayers. But the IRS is allowed to outline certain exceptions where it wouldn't be available to taxpayers, right? It also has a definition of a federal tax controversy, right? So under the definition, a federal tax controversy is defined as a dispute over an administrative determination by the IRS regarding a taxpayer's tax liabilities. This includes disputes over income, employment, excise, estate and gift taxes, as well as penalties are always in there. And there are some other items that are allowed to be considered, essentially federal tax consequences, right? That includes liabilities for certain penalties outside the IRC, the Bank Secrecy Act penalties, failing to file your FBARs, right? Those are considered to be, Treasury can, the Office of Appeals can deal with those. Freedom of Information Act requests are subject to an appeals, right, to the Office of Appeals. Sanctions of electronic return originators and authorized e-file providers. If they decide to come after you and say that you've somehow fouled up and they want to yank your right to do electronic return filing, you have a right to go before the Office of Appeals with that. Arbitrage rebate claims regarding certain tax-exempt bonds. Probably not one a lot of us deal with usually. A request for receipt of administrative costs under the code. Right, so this will be ones where we have these challenges to administrative costs under 7430, as well as, I like this last one, any topic the IRS decides to include. So in essence, this allows them via the IRB to add things. Now notice, it didn't allow them to subtract them, it allowed them to add them. The ones in this list are automatically in, but anything else they could add. They can add that through so essentially we can add but not subtract, is what they're saying. However, there are certain exceptions to appeals consideration, one of which we expect to be a bit of a lightning rod, in the current environment. Right? First thing is, if you are taking a frivolous position, appeals will not review cases involving frivolous positions and the imposition of penalties. The opinion there of the service probably is, and I'd say normally right, having looked at this for many years and read the tax protesters, cases for years, Yeah, they're normally delayed. They'd clog up appeals. The theory is, and you can't be arguing those positions. So in essence, they're saying if you want to argue over a frivolous position penalty, a frivolous position or the penalty, you go to court. The court can sanction you, and that's fine. We're good. They also will not hear appeals of whistleblower awards. Where you're asking for the whistleblower money and the IRS turns you down, you can't take that into appeals. Also, you can't take to appeals any determinations by other agencies like the Alcohol, Tobacco, Tax, and Trade Bureau. Those are excluded. You can't bring them before here. Obviously, other than Bank Secrecy Act sort of things. Any denial under the Privacy Act, to access under the Privacy Act, are not subject to appeals reviews. They also will not take cases for erroneous return or rejection of an offer in compromise. Is not something they will do. They do not take cases where there is pending criminal prosecution. Right? Generally, those wait till the end. You've seen a couple. We talked about a couple last week, as I recall. Well, at least there were a couple in the past week, the past couple of weeks that have come up where, we've had a criminal prosecution, and then somebody gets out of jail, and that's usually when they move ahead with the civil part of the case. So they're going to say if there's pending prosecution, generally the service won't go there. Also, you do remember the seriously delinquent tax debt certifications to the State Department, where they yank your passport. Yeah, you can't take an appeal to the, basically, you can't take a dispute over that to the Office of Appeals. They're not going to rule on that one. That, as far as the IRS is concerned, is a mechanical certification. So they're not going to take that referral to the Department of State over there. Got to go to court for that one if you want to have it done. Any cases where appeals lacks settlement authority, right? So if appeals doesn't have settlement authority, that is going to be there, such as referral to Department of Justice. They're excluded. If they've done that, they can't settle the case. They won't take it on. Any cases based on a technical advice memorandum, right? If there's a TAM involving a denial of tax exempt status or employee plan qualifications, that will not come before the Office of Appeals. That's not where it goes. They also don't take up cases related to whether or not to issue a letter ruling or the context of a letter ruling. That includes relief under the various rules under regulation section 301.9100-1 through 22, and a request for change in accounting method. Now, the underlying issue may be considered by appeals if other criteria are met, but not the actual fact they wouldn't do that. Now we're going to get to the more controversial one. This is any challenges to the validity of a statute, a regulation, or IRS guidance published in the Internal Revenue Bulletin, right? And we'll talk about, that particular background. So if you're going to say a statute is unconstitutional, you're going to say a regulation is not valid, or you're going to essentially, or an IRS notice or revenue procedure are invalid. You're not getting anywhere in appeals with that. You can't challenge those at the appellate level. Okay? We'll talk a little bit more about that, but basically it's there. Now, there is an exception. An unreviewable decision of any federal court where all appeals have been exhausted, that will, if there's an unreviewable opinion of a federal court that says the statute's unconstitutional, the regulation is invalid, or the IRS guidance is invalid, then appeals will hear that argument, even if that doesn't apply to you. So, for example, I'm sitting here in the Ninth Circuit Court of Appeals. Let's say that there is a district court decision in Louisiana that holds that a regulation, that my client, is negatively impacted by is invalid. Even though that's a district court case in Louisiana, has no real direct value in the Ninth Circuit. It won't bind any Ninth Circuit court to rule in favor of me on that issue. If the IRS lets the time pass and doesn't take an appeal to the Fifth Circuit on that issue, now I can go before the Office of Appeals. And the key issue there is, while we want to do that, is not that they're going to agree it's unconstitutional or whatever. It's that they can now consider the hazards of litigation. What this makes very clear is they will not take a hazard of litigation argument if such an unreviewable federal court case has not already been heard. You may actually get the IRS to back down if when you try to go forward with a case like this, but that's a decision that, to be honest, is not going to be made by appeals. That's a decision that will be made by, the chief counsel's office or, whoever's litigating the case. They might decide to settle a case at that point, but you cannot get the appeals. Appeals doesn't have the ability to do that. That's not going to be something they're going to be allowed to do. Okay. If it is a matter that's on the list designated for litigation, that's also a warning to Office of Appeals. Don't touch these. Don't settle these cases. We want them litigated. This has to go to litigation, so it'll be there. If timely appeals consideration must be requested before petitioning a tax court prerequisite jurisdiction, and the taxpayer failed to make such a request, the matter is excluded from appeals. That's part of it. It's a question of whether or not you are a denial or revocations of a certified professional employer organization status. Those cannot go before the Office of Appeals. Right? They're also not allowed. Also not allowed are issues on procedural and timing rules. The originating IRS office must complete its review before appeals consideration. Requests for appeals consideration must be submitted in the prescribed time and manner, and appeals must have sufficient time left on limitation periods to consider the matter. So, bottom line, in essence, first thing is, yes, you got to meet the 30-day letter when you have that, or whatever time manner there is allowed. You have to make sure the IRS has completed that, so the date, the clock started running, and you get this in before the clock stops running. You have to do it in the manner that the regulations require. And again, if you go to appeals, if you wait and it's too late for appeals believe they don't have time due on the statute of limitations period to consider the matter, they won't pick up the case. Right? That's it. Generally, there is one opportunity. There's only one opportunity for appeals limitations. There are some exceptions exist for cases remanded by the tax court for reconsideration. For taxpayers who participated in early consideration programs without reaching an agreement, you'll see some of those. I think we talked about that sort of program has been modified this week. So we have those, and those kind of program with early access, fast track structures, etc. As long as they say that if you participate in the program, it doesn't cut off your later appeals rights, then yes, you can go back in again. Or if new information is provided, that can also give it. Okay? If a taxpayer requests appeals, consideration after receiving notice of deficiency and that request is denied, the IRS must provide a written notice, including a detailed explanation of the decision and procedures for protesting that denial. That is a requirement based on these issues, right? Now let's talk about that limitation on considering the validity of statutes. Give a little more detail on where we're going there. Okay, this is obviously something that has become more interesting since the Loper-Bright versus Raimondo decision from the Supreme Court last summer. So what they've come down and said, there are three specific things, right? They said that they cannot challenge in more detail. They cannot challenge the constitutionality of a statute that cannot be heard by appeals absent finding a court that has ruled the statute is unconstitutional and the IRS having exhausted its appeals or let its appeals rights lapse on the matter, right? There has to be a final and unreviewable decision from a federal court holding specific statutes unconstitutional. As they note, the argument is the appeals will not be the first forum to consider such a challenge. They can consider, they note, other arguments related to the statute, such as whether it applies to your circumstances, right? And as I note, an unreviewable decision is one that can no longer be appealed due to all appeals being exhausted or the time to appeals having expired. It does not have to be a decision that is within, that in essence, that the taxpayer could force the court they go to to basically to apply. As I said, a district court decision in Louisiana. Sitting here in Phoenix, I can't get anywhere that's going to be forced to accept that court's decision. Right? It's not one of those things that's there. Now, if it's a Ninth Circuit says it, yeah. Then we're there, and then probably it's all a slam dunk. But this opens it up, right? The Ninth Circuit hasn't ruled. We have these cases elsewhere where they have ruled and said the statute's unconstitutional. It's not really an IRS appeals issue, but think about what we're seeing now with the CTA. And that's probably a good example. So far, we have had 3 courts rule that the CTA is unconstitutional. However, the government has been appealing those cases. So at this point in time, if that was an appeals office issue, which it's not, but if it was, that wouldn't be a case you could take to appeals. Right? If your charge is going to be the CTA is not constitutional, you couldn't get to appeals on that yet because the appeals rights have not been exhausted in any of the 3 cases to date. So you'd have to take your own case to court. In that theory, you couldn't use the Office of Appeals to try to get a settlement before, in essence, threatening or actually filing a court case. Similarly, you can't challenge a validity of a Treasury regulation, right? Unless you've got that unreviewable decision from a federal court. This includes both substantive and procedural challenges to the validity of a regulation. Right? In those things, however, appeals can consider whether regulation applies to your specific facts and circumstances. So if the IRS is asserting a reg applies to you that doesn't, that's fine. The reg is inapplicable to my client due to A, B, and C. But if your ultimate thing is saying, hey, wait, under Loper-Bright and under the Administrative Procedures Act, this reg's invalid, yeah, you're not going to get that. That's not going to be a win. And also, if you're going to talk the procedural validity of a notice of revenue procedure, appeals will not review arguments that a notice of revenue procedure published in the Internal Revenue Bulletin is procedurally invalid unless there is an unreviewable decision from a federal court. This is where it's defined as one that failed to comply with administrative law requirements, such as notice and comments under 5 U.S.C. 553. That is where the IRS got, hooked up on the listed transaction structures. Putting them through the IRB, and they said, no, they got to go through this formal procedure. They're not going to accept that argument unless a court has ruled, in essence, that effectively, this one is invalid in that structure. Okay. Now, the reasoning behind the restrictions, they're saying, look, they want to have consistency. If we allow these to be decided at appeals, the IRS said, then different taxpayers could end up with different results. And this is really something we don't want appeals doing, that sort of thing, until we have a court formally rule that these things are invalid. Right? And there. Also, basically, it's above their pay grade. They don't have the authority to deal with these issues that have been cleared at the highest levels of Treasury Department, the IRS. They can't unilaterally contradict these decisions. That's something I've been saying ever since Loper-Bright came out. Look, appeals is not going to take your Loper-Bright discussion if you don't have a court case to back you up. If you don't have some court action to back you up, they're not going to take it. Now we not only do you need a court action, but I need one where the appeals rights have not been exhausted. So, for instance, taking the CTA together, let's say that the Fifth Circuit does decide that the CTA is unconstitutional. Well, until the IRS, loses appeals rights, which the first one would be to take the panel and attempt to get the Fifth Circuit to go en banc with an en banc rehearing, or if that doesn't work, then attempt to go to the Supreme Court and ask for a grant of cert. Until that's happened and that's been resolved, you couldn't go before appeals. It would be pending that action. Now, if the Supreme Court were to take the offer that's been made by the IRS in the matter of trying to get the injunction knocked down and decide the whole CTA issue, based on this appeal from the Fifth Circuit of the preliminary action, obviously, if the Supreme Court says, yep, it's invalid, then they need to worry about appeals too much. It's just flat invalid. That would be the end of the appeals process. at that point. So that's kind of where it goes. And finally, they're saying they're going to argue that this gives efficiency, right? It avoids expending resources to review validity challenges that have not been deemed invalid by a court. And like they say, this encourages efficiency by ensuring determination communicated and applied to all taxpayers. So basically, besides it's above their pay grade argument, the other two arguments for consistency and efficiency is primarily saying, well, until it's been clear, there's been a clear ruling, and all taxpayers therefore be notified of the fact there is that ruling, at least in theory. The court cases are public. We don't have this private. Remember, appeals processes aren't published, so everybody doesn't get to see what happened in your appeals case. We don't want these private deals as their theory, which would be great, except when they talk to the actual litigation, it could still be settled by the chief counsel's office, even if it's not settled at this point, right? And a couple of other issues we have here. They do note that it's not a complete ban. Simply means appeals will not address information about the validity of these items unless the court has already made an unreviewable ruling, right? And appeals can still consider the application of these items to a specific condition. And again, unreviewable decision is one from any federal court, not just a court where the taxpayer resides or has jurisdiction over the taxpayer, that can no longer be appealed, either because appeals have been exhausted. You've gone all the way to the Circuit Court of Appeals. You asked Supreme Court to review it, and they denied cert, or they heard the case and issued an opinion, or time just ran out. The IRS decided not to file the next step in the appeals process. That'll be considered to be an unreviewable decision. Okay. This has been the Current Federal Tax Developments for January the 20th, 2025. Current Federal Tax Developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. Hopefully you've had a good week here coming in, a good time coming in January. We are approaching the days when the 1099s all start showing up, and all those nice tax returns start showing up. For those of you who are in compliance work, have fun. But we will be looking at what other comes up. We do have the inauguration this week. We will see what steps they take about dealing with these regs that have been issued toward the end of the Biden administration. As I said, traditionally, we see a lot of regs issued at the end of administration, and then a lot of those regs, modified, reversed, held, all kinds of weird things happen. So you want to keep an eye on that over the next week and what goes on. And sometimes things get held up and then they just get let through. A lot of times we've seen that go on when administrations change. So keep your eye on that stuff, plus any other guidance that might be issued. But otherwise, we'll see you back here next week for more current federal tax developments.